If this video showed up in your feed, there is a very specific number attached to your situation right now. $743,000. That's the median gap between what the average American household has saved at 45 and what they actually need to stop working on their own terms. And the reason that number exists has almost nothing to do with what you did wrong. It has everything to do with what nobody told you at the right time. But here's what's different about you, the person watching this right now. The fact that you're here, reading content like this, running your own numbers, asking these questions, already puts you in a category that most financial data says doesn't make it. And I want to show you exactly how close you actually are, because the distance between where you are and where you want to be is almost certainly not what you think it is. Let me start with a number that the financial services industry has no incentive to advertise. According to Vanguard's 2024 How America Saves report, only 23% of Americans in the 35 to 54 age bracket are on track to replace at least 70% of their pre-retirement income from personal savings alone. 23%. The rest aren't there yet. But here's the thing nobody explains about that statistic. Being in the 77% right now does not mean you end up in the 77%. It means you're in the window where decisions made in the next 5 years compound harder than any decisions made after 60. The people who eventually make it almost never started ahead. They started paying attention. I want you to think about a pressure cooker. Not a complicated appliance, just the basic version your grandmother probably had. When you put food inside a pressure cooker and apply heat, nothing dramatic happens for a long time. The lid looks sealed. The gauge doesn't move much. You could stare at it for 20 minutes and conclude nothing is happening. Then the pressure builds past a threshold, and suddenly everything accelerates. What took 45 minutes in a regular pot takes 12 minutes in a pressure cooker, not because the temperature changed dramatically at the end, but because pressure had been accumulating invisibly the entire time and finally crossed a point where the physics changed. Your portfolio does exactly this. For years, it looks like a regular pot. The contributions go in, the balance inches up, the returns feel insultingly small. You contributed faithfully and the market added what amounts to a monthly car payment. Then somewhere around a specific balance level, which I'm going to show you with actual numbers in a minute, the physics change. The pressure is finally high enough. Your money starts doing work you couldn't manually replicate. That transition doesn't announce itself. It just starts showing up on your monthly statement as a returns line that starts competing with your contribution line. If you are 40 to 55 and you've been putting money away consistently, there's a very real chance you are closer to that threshold than you have ever been. And the single most expensive thing you can do right now is misread the silence before the pressure kicks in as evidence that the strategy isn't working. Here is the table nobody puts next to the motivational compound interest chart. All of these use a 7% annual return, which is the S&P 500's inflation-adjusted historical average going back to 1926, according to data compiled by Robert Shiller at Yale, a conservative and defensible number, not a best-case scenario. Starting balance of $80,000. If you contribute nothing for 15 more years, that $80,000 becomes approximately $220,000. If you contribute $400 a month for those same 15 years, the result is approximately $370,000. If you contribute $800 a month, approximately $530,000. Same starting point, same time, same return. The only variable is the monthly input. Now, starting balance of $150,000. Zero contributions for 15 years, approximately $414,000. $400 a month, approximately $560,000. $800 a month, approximately $720,000. One number changes and the gap between outcomes grows from $190,000 to $306,000. Same rate, same time. The pile size is doing most of the work, and the contributions are accelerating when the pile gets to that threshold where compounding starts running the show. The median 401k balance for Americans aged 45 to 54, according to Fidelity's Q4 2024 data, is $148,000. If that sounds familiar, stay with me, because that number is closer to the threshold than most people realize. Here is the anti-diagnosis, the one that will make the rest of this video click. You think the problem is that you haven't saved enough. The actual problem is that nobody showed you the specific number where enough stops being about saving and starts being about staying. There is a threshold, a calculable point in every investor's timeline, somewhere between $100,000 and $175,000 in invested assets at a 7% return, where your annual market gains start to exceed your annual contributions for the first time. Below that threshold, you are the engine. Every dollar of growth is a direct product of your labor, your discipline, your monthly deposit. Above that threshold, something shifts. Your capital becomes a coworker who doesn't take vacations, doesn't ask for a raise, and whose productivity is proportional to the size of the pile. The financial media almost never talks about this threshold by name because there's no product attached to crossing it faster. You can't buy a fund called Cross the Threshold Sooner, so they talk about return rates, which makes for better thumbnails and generates more trading activity, which is how they get paid. The lever that actually moves your outcome in the next 10 years isn't finding a smarter fund. It's the decision you make this month about what percentage of the next income event you redirect before your lifestyle knows it exists. I want you to meet someone. Her name is Linda. She is 47 years old. She works as a project coordinator at a mid-sized healthcare company in Columbus, Ohio, earning $68,000 a year. She has been contributing 6% to her company, $401K, since she was 34, never missing a month, never panic selling, never pulling a loan from the account. Her current balance is $112,000. She checks it quarterly, feels vaguely behind according to every article she's read, and has started wondering if she should be doing something more aggressive, maybe individual stocks, maybe a side investment in a friend's business, maybe a rental property that a coworker keeps talking about. Linda is not behind. Linda is 3 to 4 years away from the threshold where her account generates more in annual returns than she contributes in a year. She is, by the data, in exactly the position that leads to financial independence by her early 60s if she doesn't introduce complexity into a system that is already doing the right thing. But nobody has shown Linda that specific number, that specific timeline, or that specific threshold, so she feels like she's failing a test she's actually passing. We're going to come back to Linda. Before I get back to Linda, I need to show you the number that the financial planning industry has quietly buried inside its own research for 30 years. Dalbar, a financial analytics firm that has been tracking actual investor behavior since 1994, publishes a report every year comparing the return the S&P 500 actually delivered against the return the average equity fund investor actually captured. Over the 20-year period ending in 2023, the S&P 500 returned 10.2% annually. The average equity investor captured 6.8%. That 3.4 percentage point gap is not fees. It is not inflation. It is behavior. People moving to cash when the market dropped and buying back in after the recovery was already priced in. People switching strategies at the exact moment the original strategy was about to compound hard. People doing the expensive thing that felt like the smart thing. 3.4% sounds abstract until you put a dollar amount on it. $150,000 at 10.2% for 20 years grows to approximately $1,060,000. The same $150,000 at 6.8% grows to approximately $560,000. The behavioral gap, the cost of doing the thing that felt correct at moments of peak fear, is $500,000 on a $150,000 base. $500,000. Not lost to a fraud, not lost to a bad stock pick, lost to the timing decisions that felt rational and were statistically almost always wrong. The person who crossed the threshold and then stayed out of their own way captured the full number. The person who felt the fear and acted on it captured barely half. And here is what makes this specific to you, the person watching this kind of content on a Tuesday afternoon or a Saturday morning. The Dalbar data is pulled from the average investor. The average investor is not watching videos about compound interest thresholds and behavioral finance gaps. The average investor is not building frameworks for understanding which phase of wealth building they're in. The average investor opens their 401k statement twice a year and makes decisions based on the headlines they saw that morning. You are already operating in a different category. The question is whether you are operating in that category consistently enough to capture what the math is building for you right now. Let me show you what the silence actually means. because this is the part that nobody explains in a way that sticks. When you are in the phase before the threshold, the phase where your contributions account for more than 70% of your monthly account growth, the silence is structural. It is not a sign that the strategy is broken. It is the physics of how exponential curves work before they go vertical. A curve that will eventually go vertical spends most of its life looking completely flat. The early section of an exponential curve and a straight line are visually almost indistinguishable. You cannot tell them apart by looking at last month's statement. You can only tell them apart by understanding where you are on the curve and how the math changes past the threshold. Morningstar's 2024 investor return study confirmed what Dalbar has been documenting for decades. The gap between fund returns and investor returns is widest in the years right before a bull market recovery, meaning the exit decisions that cost the most money happen in the exact window when staying put would have produced the best returns. The silence before the pressure cooker activates is not dead time. It is load-bearing silence. Every month you hold through it moves you closer to the threshold. Every month you exit and re-enter costs you something that a spreadsheet won't show you until it's already happened. Now I want to talk about the specific number you actually need. Not a vague target, not a motivational aspiration, a real number grounded in what passive income actually requires at current rates. According to the 4% rule, which William Bengen published in the Journal of Financial Planning in 1994, after backtesting withdrawal rates against every historical market sequence going back to 1926, you can withdraw 4% of your portfolio annually with a high statistical probability of the money lasting 30 or more years. That number has been stress-tested, critiqued, and refined, but the core framework holds for most retirement timelines. If you need $40,000 a year from your portfolio to live comfortably when combined with Social Security, you need a $1 million portfolio. If you need $60,000 a year, you need $1.5 million. If you need $80,000 a year from investments alone, that is $2 million. Those are not impossible numbers for someone in their mid-40s with a consistent savings history. They are calculable distances on a timeline that still has 15 to 20 years of compounding ahead of it. And here is what the timeline math actually says about someone in Linda's position. Linda is 47. She has $112,000 invested. She contributes approximately $340 a month, which is 6% of her $68,000 salary. At 7% annual return, Linda's current trajectory puts her at approximately $590,000 at 65. Her Social Security benefit at full retirement age, based on her earnings history estimated by the Social Security Administration's own calculator, is projected at roughly $22,000 annually. Combined with a 4% withdrawal from her portfolio, that is approximately $45,000 a year. Enough to live on in Columbus, Ohio, but not with the margin she deserves after 30-plus years of working. The gap between her current trajectory and the $1.2 million that would give her genuine financial flexibility is approximately $610,000 at retirement. That sounds enormous. But it is not a function of how much she failed. It is a function of one single variable that nobody ever told her to adjust. By the way, if this kind of analysis is what you come here for, subscribe to the channel. It costs you nothing, and it is the only way the algorithm keeps showing you this content. I make this to reach people who are actually thinking about their financial situation, and subscriptions are what make that possible. The variable is contribution level. Not fund selection, not market timing, not a side business, not crypto. The monthly input number. Linda has never updated her contribution percentage from the 6% she typed into an enrollment form when she was 34. Her salary has grown. Her fixed costs have shifted. But the autopay still runs at the number from 13 years ago because updating it requires a login that never gets scheduled. This is not a personal failure. It is institutional inertia by design. Plan administrators make it easy to enroll and frictionless to forget. The financial services industry profits from the gap between what you are contributing and what you could be contributing. Every dollar that does not flow into a low-cost index fund is a dollar available to be captured by a fee structure somewhere. The system is not rooting for Linda to maximize her contribution. The system is designed to collect a fee from wherever the money is sitting. If Linda increases her contribution from 6% to 12%, an additional $340 a month on her current salary, Her retirement projection changes from approximately $590,000 to approximately $980,000. Still below $1.2 million, but now within range of a single raise or a single contribution bump in her early 50s, closing the remaining gap completely. And here is the number that makes this concrete. The annual cost of staying at 6% instead of 12% for Linda specifically, compounded over 18 years at 7%, is approximately $390,000. $390,000 sitting in the gap between a form she filled out in 2012 and a login she has not made since. That is the hidden cost of institutional inertia. Not a scandal, not a fraud, just a form that nobody told her to update. There is one more hidden cost that sits underneath the contribution gap and makes the whole problem worse in a way that only becomes visible when you run the specific numbers. Expense ratios. The U.S. Department of Labor published a document that every American investor should have received on their first day of employment, but almost nobody has ever read. It states plainly that a 1% difference in annual fees will reduce your retirement account balance by 28% at retirement. Not 1% less, 28% less. Think about what that means for Linda's situation. If her $112,000 is sitting in an actively managed fund, charging 1.1% in annual fees, which is completely standard and almost always invisible inside employer-sponsored plans, versus a Vanguard Total Stock Market Index fund charging 0.03%, the fee drag over 18 years at 7% gross return costs her approximately $160,000. $160,000 that her money generated and then handed to a fund manager who, according to S&P's SPIVA scorecard published every 6 months since 2002, had roughly a 92% probability of underperforming the index over that same period. Linda is paying for underperformance, and she does not know it because the fee does not appear as a line item on her statement. It is extracted before the return is calculated and reported. The number you see on your statement is already net of the fee. The cost is invisible by design. This is not a conspiracy. It is a disclosure structure that the financial services industry lobbied to keep exactly as confusing as it currently is. 12 minutes. That is how long it takes to log into your plan, find the Fund Details tab, look at the expense ratio column, and identify whether a lower cost index equivalent exists inside the same plan. In most corporate 401k plans, it does. You switch. You set it. You do not touch it again. That 12-minute decision, for someone in Linda's position, is worth more per hour than almost any side income she could realistically generate. Now let me show you the full picture of what Linda's situation actually looks like when you correct for both variables at once. Starting balance, $112,000. Current path, 6% contribution rate, 1.1% expense ratio. Net return approximately 5.9%. Result at 65, approximately $480,000. That is the real current trajectory once fees are factored in, not the headline number. Path 2, 12% contribution rate, expense ratio dropped to 0.05%, net return approximately 6.95%. Result at 65, approximately $1,090,000. Path 3, 15% contribution rate, same low expense ratio, one raise redirected in her early 50s, net return approximately 6.95%. Result at 65, approximately $1.3 million. Add her Social Security projection of $22,000 annually, and Linda at 65 is looking at roughly $74,000 a year in income, 4% withdrawal from $1.3 million plus Social Security, without selling her home, without a side business, without a single investment she does not already understand. That is financial independence on a $68,000 salary from Columbus, Ohio. That is the real math that nobody showed her when she was 34 and filling out her enrollment form for the first time. The system showed her a contribution percentage field and a list of funds sorted by 5-star ratings. It did not show her the threshold, the fee drag, or the distance between Path 1 and Path 3. It showed her a starting line and called it a plan. Here is what I want you to take from this before I give you the 3 specific actions. The frustration you may have felt looking at your balance recently, the sense that you have been doing everything right and the numbers still feel insufficient. That frustration is a correct response to a system that was not designed to show you your real progress. The benchmark you have been measuring yourself against, the one that says you should have 3 times your salary saved by 40 or 10 times by 67, those benchmarks assume you started at 22 with no student debt, no career interruptions, no periods of reduced income, and a clear explanation of how compound interest thresholds work. Almost nobody got that. The fact that you are still here, still contributing, still paying attention, means you are doing something that the Dalbar data says most investors stop doing at the first sign of a bad year. You are not behind. You are in the load-bearing silence before the pressure cooker does the part of the work you cannot do manually, and the distance between your current trajectory and the one that ends in genuine financial freedom is almost certainly smaller than you think, and almost certainly fixable with decisions you can make in the next 48 hours, not the next decade. 3 actions. Specific. Low friction. Executable this week, not someday. Action 1. Find your threshold date. Open any compound interest calculator online. There are free ones on investor.gov, the s.e.c's official site. Plug in your current balance, your monthly contribution, and 7% annual return. Find the year your balance crosses $150,000. Write that year down. Then ask, what monthly contribution amount moves that date 2 years earlier? Run the number. The difference in your terminal balance from hitting the threshold 2 years sooner, even at a modest starting point, is almost always between $80,000 and $150,000. That is the number you are managing your financial life around right now, not the return rate, not the fund selection, the threshold date. Action 2. Audit your expense ratio today. Log into your 401k or IRA. Find the Fund Details tab or the prospectus link. Look for the line that says expense ratio or annual fee. If any number is above 0.5%, search inside the same plan for a comparable index fund. In Fidelity plans, look for Fidelity Zero funds. In Vanguard plans, look for Admiral shares. In most Schwab plans, look for Schwab index funds. The switch takes 4 clicks. The compounding benefit of that 4-click decision over 15 to 20 years is often larger than any raise you will receive this year. Do not wait for the right moment. Log in tonight. Action 3. Pre-decide your next income event. Your next raise, tax refund, bonus, or loan payoff. Whichever comes first, pick a percentage right now before the money exists in your hand. Write it down. 50% of net increase goes directly to your 401k contribution rate, effective the pay period. The raise starts, not the month after. Not when you get around to it. The same pay period. The decision made today in the abstract while there is no actual cash to spend is the one that executes correctly. The same decision made while holding a direct deposit notification and standing next to a home renovation idea almost never goes to investments. You are not relying on willpower here. You are making the decision at the moment of lowest behavioral friction and then automating it so future you cannot undo it impulsively. Now, Linda, I told you we would come back to her. Here is what Linda did with this information when she ran her own numbers. She logged into her company 401k and found her blended expense ratio was 1.14%. She switched to the Vanguard Institutional Index Fund available inside the same plan at 0.04%. She increased her contribution from 6% to 11%, an additional $312 a month, which she found by canceling 2 subscriptions she had forgotten about, not renewing a gym membership she had not used in 14 months, and redirecting $150 of monthly discretionary spending she genuinely did not notice. Her car loan ends in 7 months. She has already set a calendar reminder for the day the final payment clears to increase her 401k contribution by another $250 a month automatically. She did not change her investment strategy. She did not open a brokerage account for individual stocks. She did not buy anything she could not explain to her sister over dinner. She made 3 decisions that took a combined total of about 90 minutes. Her retirement projection moved from approximately $480,000 to approximately $1.1 million. $620,000 of additional retirement wealth from 90 minutes of administrative decisions that the financial services industry spent decades making sure nobody explained to her clearly. That is not a miracle. That is the math that was already there, running on her behalf, waiting for her to stop letting the system extract from it silently. The investors who end up with the number they wanted are almost never the ones who found the right trade or the right timing. They are the ones who understood which game they were actually playing, stopped optimizing for the wrong variable, and let the system do the work it was already designed to do. You are already in the game. You are already contributing. You are already paying attention. The pressure is already building. Your only job now is to stop pressing the release valve right before the cooker does the part you cannot do yourself. Subscribe if this is the kind of content you want to keep seeing. The algorithm only shows you what it thinks you engage with, and this channel exists for the people who are thinking seriously about their financial situation and deserve straight answers without a product attached to every paragraph. The math is already running. Stay out of its way.